we are recording. I see a red dot.
Yep.
Good afternoon. This is Jim Riggio. Today is the 15th of September. We're doing our weekly market review. We have a couple of guests with us. One of them is my trading partner, former Goldman Sachs partner. His name is Ian Scott. I asked him to come on. We only have about five or 10 minutes with him because I had been asked if we were going to participate in the Alibaba IPO on Friday. We've been doing so since mid-July. What we looked at, what Ian did the research on, was who were the owners of Alibaba besides Jack Ma. And upon doing that, Ian, why don't I turn it over to you about how you ended up taking a look at Yahoo and the valuation process you went through?
Yeah, I just saw a nice opportunity here to maybe buy some call spreads into an IPO, and I feel like that's normally an unusual and non-tradable event because obviously, you know, the IPO will happen and there'll be some time period before options will be listed. Yahoo presented a nice opportunity to trade, or I believe to trade the Alibaba IPO, because the core business of Yahoo is basically worthless, or so the market prices it, and they've got this 22.4% stake in Alibaba, which is the lion's share of the market cap as represented today, along with a $9 billion stake in Yahoo Japan, which is a publicly traded company in Japan. And basically what I did was I put together a valuation spreadsheet pre and post tax for Yahoo, and with them just increasing the IPO range now, looks like the IPO valuation for Alibaba will be about $175 billion, and that'll bring in Yahoo about $7 billion in cash. Additionally, they'll retain a 16.3% stake in Alibaba post the IPO, and I figured about a 15% pop on day one, gave it a $200 billion valuation. I think that's conservative. I actually think we'll see a higher price from Alibaba on the IPO. I think a lot of times when these IPOs come, obviously no one can sell these short, and you often see large up moves on the first day. I think people will be excited about this particular IPO. And that basically brought me to a way to trade it, which has been Yahoo. And starting in about July, Jim and I began accumulating calls in Yahoo, and we still hold a lot of those calls. I actually did close out some of those today because I saw some weakness in the stock. Might be a nice opportunity with the weakness, though, to put on some additional call spreads tomorrow morning, especially if they push the stock down a little further, as I believe going into the end of the week and after the IPO, you're really going to see a pop in Yahoo. Basically, Yahoo, as I price it right now, has a valuation post-U.S. tax, which obviously we all know the U.S. tax rate is quite high, of about $40 a share. And then recently there's been speculation of a foreign buyer coming in to buy Yahoo, and if they do, they obviously avoid that 35% tax, and then you get an intrinsic value of Yahoo at $54 a share. Obviously, that's a much more enticing number if I'm long the stock at here at 42.55 went out today. And then I've been speaking. Here's the
interesting part, Ian. You talked about the valuation, three components: Yahoo's business itself, their ownership in Yahoo Japan, and their ownership in Alibaba. What valuation are you giving their core business?
I'm giving the Yahoo cash. They had a cash on their balance at the last earnings report of $2.7 billion. I am valuing the core business at $3 billion. I got that valuation from the corresponding value in AOL, which has similar revenues, similar declining growth, but they do generate a lot of cash, and AOL, I believe, has a valuation just around that $3 billion number. So I am assuming the $2.7 billion in cash on the books, a $3 billion for the core business in my calculation to get to the 39.69 post-tax number and the 54.28 non-tax number.
Okay. So it's not like you didn't end up going out and giving it any valuation. You just took standard middle of the road book value almost of theirs.
I tried to be as conservative as possible with the valuation. I mean, I feel like Yahoo, core business with declining revenues, I understand that people think it's not a valuable asset, but an asset that throws off a few $100 million in cash, free cash a year, has to be worth something. Like I said, I used the AOL and I went off and got the $3 billion valuation. You can make the argument it's $2 billion, maybe even $1 billion. Yahoo's float right now is 1 billion shares, so it's real easy to just shave $2 billion off that valuation if someone doesn't like it, and then you'd have 37.69 as a post-tax number and 52.28 as a non-U.S. tax number. And when I saw this, when I started to put this trade on, Yahoo was trading around $35, $36. They had a bad earnings report. The stock got hit down to 32. I continued to accumulate the position. And then I came to Jim and said, what's the best way to trade this from a vol standpoint? And I think, Jim, why don't you take over and show some of those skews and what we looked at and how we ended up in the different positions we did.
Okay. Ian, listen, thank you very much. Please comment for as long as you can stay on. I know you have another appointment, and I really appreciate you giving us a little bit of time to take us through the evaluation. What ended up happening when Ian first came to me is that we took a look at it, and the IPO date they weren't sure of. There was going to end up being a range, and they were going to actually try to do the IPO at some time in August, and it got pushed a couple of times. And one of the things that we ended up doing is that a lot of times when you're that far, 2 months in front of an IPO date, a month and a half in front of an IPO date, the IPO date isn't specifically set. Because this thing was going to be so big, there was a reasonable chance that they slip what they're talking about, the rumors of their range of where they're going to try to end up doing it, they slip it back a week or two. So what we ended up doing was the following. And I'll start with this. We both started accumulating October, not September. We weren't trying to cut it, but too short. We wanted to have at the time. Remember, it's supposed to come out mid-August. We wanted to have at least 2 months of float between when they said it was going to happen and when we were actually buying. Unlike earnings, where you kind of know where it's going to end up being, here we were able to actually end up saying they're not sure, so let's give us a little bit more time. Has anybody ever ended up, buying, let's say, a call or a put for earnings, and then what they end up doing is that they slip their earnings date by a few days, and it goes behind the date of your option? What happens to the implied volatility? I mean, it all gets sucked out. Now, knowing that that was a possibility, what we ended up doing is that we bought October options, and what I was doing, I consistently sold. I was selling options. I bought 40s and 45s in October, and then I constantly sold earlier options. And here, I'll end up showing you my trade here that I have here. Let me import. And this is in a fund that I help manage. Okay. So you can see here what I did was that these were the 40 and 45s that I had originally bought, and I've sold Julys against them. I've sold multiple Septembers against them. The best sale, by the way, was when they ended up coming out with the target range in October. I sold for the Friday, of the week that they were coming out, and they were coming out midweek. Then when they slipped it, all of the vol came out of this. I tried to end up doing this again, with the Septembers. You see, I have options here that are sold on Friday, but they never slipped it. If they would have slipped it, the vols would have come out of that, and then I would have been. This does not end up including any of the options that I've sold. So this is not any of my P&L. And this is what my P&L graph looks like. For those of you not familiar, the white line is current, and the red line is at expiration, which means after Friday. So depending on what ends up happening, we'll end up taking a look at the implied volatilities on this thing on Thursday afternoon. We've been watching up the entire time. Here's where I love, how I end up judging a trade. What you're looking at here. Not Tesla. We don't want Tesla. That was what we were looking at before. Here's the Yahoo, implied volatility skew curve for 25% above, 25% below the money. If I go out to 50% above and below the money, it just gets a little bit steeper. So what you're looking at is the date is on the left-hand side. The y-axis is the IV percentage, and the x-axis are the strike prices. So if I hold my cursor over here, I can see that this strike is the implied volatility for sorry, there we go. The implied volatility for the 41.5 output. You can end up seeing what any of them are because this is an abnormal skew curve, meaning that the implied volatilities are call-based, that the implied volatilities get higher as we go up. It makes a lot of sense for anybody who's still looking to end up playing this to end up buying a call spread where I'm buying a call lower below the money and then selling above it. What we ended up doing, Ian and I, and I'm not sure if he's still on the phone, we ended up doing this last week, okay, when the
I
market
am still
showed
here,
over.
Jim.
Okay. What day did we end up doing the vertical?
I want to say Thursday.
Yeah, I thought it was Thursday also. I don't have my notes here. So what we ended up doing on Thursday was we ended up buying, and here's just a small little trade that I had put on in another account, okay, as I modeled. What we ended up doing is we bought the 40, sold the 44s, and the reason we ended up doing that was that the implied volatility was just so high that I wanted to buy a lower implied volatility and sell a higher implied volatility. So if you end up taking a look at what that ended up looking like, buying a 40 implied volatility, and I think I might be there, this one, right? So I'm buying the implied volatility here at 87, and then I was selling the one up here at 97. When we ended up actually doing it, I remember there was like an 11.5, almost a 12-point difference between the implied volatility. I'm buying a lower vol, selling a higher vol, going in the direction that I want. So I was very, very pleased with the way the implied volatility had. What I ended up doing was that in order to sell more stuff above the money, I actually put a second trade on, a butterfly above the money, and then when you look at them together, that's what the trade looks like. So what it's playing for is that as the market ends up running up with Yahoo going into the IPO, if we end up coming anywhere around here, remember this is Friday, so we're going to get an absolute vol crush on Friday. So what I'll end up doing is probably trying to close this trade Friday morning once the market opens, but before
Alibaba
the
trades.
IPO, before it actually trades. The vols will, once they start to end up getting a range and they start to end up announcing it, that it looks like it's going to be within this range, the implied volatilities will come out of this thing.
And that would be the range, obviously, that would be obviously the range that the specialists will begin to put out before they open the IPO on the NYSE on Friday morning. If it, let's say the range now is 66 to 68, assume they price at the high end of 68, you'll see the specialists 70 to 72, 72 to 74, 74 to 76 begin to put a range for the opening print. We're of the belief that will be higher and that you'll see immediate shocks in the vol and the price in Yahoo on Friday morning as those ranges come out.
Right, and Ian has built a spreadsheet, so as we end up seeing the ranges, what they're going to price it for, we'll keep the ranges in the spreadsheet, and then that'll end up translating to what the value of Yahoo should end up trading at, both pre and post tax of what they're going to be collecting. So we feel pretty good about it. But the biggest thing that I wanted to end up talking about this is that I got asked on Sunday from another retail trader that I speak to once in a while about how was I planning on trading the Alibaba IPO. And the answer for E and I is we plan on having our trade close and watching as spectators. Our money is going to already be made, right? The easy money in a lot of ways was already made. When you end up taking a look at, let me show you stuff that Ian has in one of the accounts that he ends up running. Right. I'm sorry. This is one of the accounts that I end up running, not including some of the calls that I've sold. So I mean, I love where I am right now. Here's the other thing: as we get closer, implied volatilities go up. So when we're buying the back months that were kept going. Our October that we bought. Yes, we made a lot of money on deltas, but we also made money on implied volatility because we bought them early enough that we knew that the event was going to end up coming, and the event is almost like an earnings event. As we got closer, we knew the implied volatility was going to go up, but unlike an earnings, the excitement of it can really end up lasting, weeks on it. So we didn't think that those Octobers would end up getting a vol crush like the ones that expire that afternoon would end up getting. So all in all,
Alibaba officially raised the IPO price range to $66 to $68 shares, rumored.
Okay, and here's what ended up happening right afterwards. Okay, it moved up a little bit. And I'll show you just a couple of things. Like, for example, if I end up showing you Ian's position, okay, that he ended up having on, okay, this was basically the position he had on. He was long the 40 Octobers. Unlike me as an options trader, like it's against my religion, okay, to end up, buying something naked long or naked short. I always say if I buy something, I always have to sell against it. He held these things. At times, I looked smart, okay, at other times, he looked much smarter because the stuff just kept going up and up and up. The verticals that we put on also ended up looking real good. And so when we talked about what to end up trading against this, what we took a look at this morning is that we said the 50 calls for next Friday were going for 79 cents. So, I take a look at this, you're giving up a little bit of the upside. The vols are going to get hurt in that because you only have 7 days to after the IPO. And so to collect that much money up front made so much sense. If you take a look at what happened during the day, right? If you're looking at a 1-minute chart on a Yahoo for the day here. So they were sold for 79 cents early in the morning. As it tanked during the day, the trader in Ian couldn't be helped, and he saw a quick profit to be able to take on that, and he took it. What did you buy him back for after selling him for 79 cents?
51 cents.
Right, beautiful trade, and if it pops tomorrow, he'll get a chance to sell him again.
Yeah, that was my hope. And I would just make one point because then I've got to step off, and that's, I know a lot of people ask about the Alibaba IPO and can they participate in the kind of returns that they would expect even if you get in on the IPO price and you sell at the high of the day. I still think that you're going to see a better risk-reward ratio in some of these call spreads, like the 40-44 call spread that Jim and I both have on is trading at around $2. If you get a little pullback tomorrow in Yahoo and you can get that on for under $2, I think I like that trade because your risk-reward ratio should be about 50-50, and I think you've got a pretty good chance at landing in the money because I think that Yahoo should trade higher than 44, assuming obviously that, I'm making the assumption that the Alibaba IPO is going to be a success. If you're going to enter into this trade, you have to believe that the trade is going to be a success. If you think it's going to be a flop like Facebook, this is definitely not the trade for you.
And this is the trade that he was just talking about. Hey, Tony, you know what we call what Ian just did? He's talking his book. Right. We both have this trade on. It is a good trade. The other day on Thursday when we had that small pullback, I took a look at it. I thought it was a very reasonable trade. Okay, just a smaller size, right? Risking, let's call it $3,500 to make $6,500, right? And we thought that we had a pretty reasonable chance to end up making that
better than 50-50.
Better than 50-50. Right? So if I can end up getting a better than 50-50 chance to end up putting on a trade, and I have to risk one to make two, that's a great trade. Those are the types of trades that aren't our core trades that we run our business on. But when these opportunities have you have better than 50-50 and it pays 2 to 1, how do you not take that? Anyway, any questions for Ian before he goes? Because we've already kept him over, and I know he's got to get to his next meeting.
I have one question for Ian. This is Tony. So basically, using Yahoo as the surrogate, makes a ton of sense. But is the reason that you picked Yahoo as your surrogate trade for Alibaba, is that because of Yahoo's involvement with them versus other companies that might, be similar in the space? I mean, is it because they're intimately involved together, like you said?
It's the ownership. It's the straight ownership. Yahoo owns 22.4% of Alibaba. Jerry Yang, the previous CEO of Yahoo, aside from destroying his company, made one extremely great successful trade, where for $1 billion, he bought 40% of Alibaba. There were some transactions where they sold some back to Alibaba a few years ago, but Yahoo actually owns 22.4% of Alibaba. So if a $200 billion valuation of Alibaba, you're looking at a price of almost $45 billion in Yahoo's stake, and at $1 billion a share, it's $45 a share standing on its own. That's why I chose Yahoo. Yahoo owns 24% of Alibaba. SoftBank, the big Japanese company, Masasan, owns about 50%. Why I chose Yahoo and not SoftBank, trying to get the ownership of Alibaba, was the balance sheet in Yahoo is a little cleaner. It's really just Alibaba. SoftBank owns Sprint. They own some other stocks, and that maybe would be a little bit more difficult for me to value. I chose Yahoo because the lion's share of their valuation is in this ownership that they have in Alibaba. So it's not a business relationship. It's actually an ownership. They'll profit from the IPO, selling a prearranged stake of about $7 billion post-tax in cash for Yahoo. And then after that, they'll have about 16% of the remaining stake in Alibaba. So if you're watching Alibaba trade after, and you can see the valuation of Alibaba, it'll be very easy to translate. Just take 16% of that, and that's the ownership that Yahoo will actually have.
Makes total sense.
Yeah.
Okay. Thank you very much. I knew you need to get going, and go ahead, get going. The thing I'd end up adding is that I had looked at this. I had mentioned to Ian. I looked at the ownership of SoftBank, and I said, what happens if I end up buying SoftBank, which is only listed, it's not listed in the U.S. You have to end up buying it overseas. And then I go and I short in a percentage as many of the other holdings within SoftBank as I could. And it was just it was a little bit messier transaction, didn't give me the risk-reward ratios that I wanted. By the way, for their private clients, and I forgot which bank it was either Goldman or it could have been Morgan Stanley or JP Morgan. One of them ended up offering this service to their clients where they would end up buying it as a bundle, buy SoftBank, short everything that they could else that SoftBank owned. This gave us a lot better risk management on the downside if things didn't work.
And a lot better liquidity. Yahoo traded 71 million shares today. You're getting great liquidity in Yahoo. That I think SoftBank actually does have an ADS or an ADR of the trades, but it's not going to trade anywhere near the volume of the Yahoo calls, puts, or the underlying equity.
So, Ian, thank you so much.
I want to step off.
Really appreciate it. Get going to
your
your meeting.
Good luck trading and make a lot of money.
Thanks, Ian.
Take care. Bye.
Okay, guys. I wanted you to end up hearing that I've been trading with Ian for maybe about 6 months or so. Ian's background, which we didn't have time to end up going through, is that he originally was with Spear Leagues Kellogg, was a trader with them, and when Goldman bought Spear Leagues, he became a trader with Goldman, was there for a whole bunch of years, and then ended up moving down to Florida, actually works out of Fort Lauderdale, and ends up investing for closely held, which just means private clients only, a group out of Fort Lauderdale. And we've been working together to try to end up combining what we end up doing, because there's a lot of synergies. As you saw what he ended up doing, going through the evaluations in the range, he would normally end up playing things with just individual stocks. What he trades is actually extremely interesting, an ETF arbitrage where he might buy an ETF and sell the components. The challenge is that the high-frequency guys have really put a huge crimp in his main business, and he trades it both pre- and post-market when the high-frequency guys aren't there. But as he looks for more of these trades, the risk-reward ratios that the options market and the implied volatilities, which I kind of specialize in, end up just being a great fit for these types of plays. That being said, before we get to our regularly scheduled program, any other questions just about the approach? I know we went really fast, but we had a number of people asking us, and it really is quite an interesting play because you guys have all heard the old expression, buy the rumor, sell the news. We bought, I always think the great traders are getting out of the trade while the hype is at its frenzy. You know, I make fun of Ian because he likes to end up making fun of CNBC, and he has it on in his office. But by the time they're announcing things today was the very first time I heard on either Bloomberg or CNBC sources about why Yahoo has been up so much in the general news. Yeah, there might be little, segments in here, but as they were doing their movers on the day early on, they brought it up. It was the first time I had heard it. And as you see, we're getting ready to, map out our exit strategy within, by the end of the week.
Nice looking trade, Jim.
So, thank you, guys. Okay. What we gave you was an insight, okay, what Capital Discussions is, here's our disclaimer. And so if we end up getting started, can I ask you, Tom, just to kind of end up going through this real quick, because I know you have this thing memorized.
What's that, the disclaimer?
Yeah.
Oh, yeah, sure. Let me just run through that.
We're not a registered investment. We're not recommending these trades. We don't know your situation. We're just sharing with you.
Yeah, we're not a broker-dealer. Yep. Risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. Actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And we do have our standard disclaimer on our website that you can watch or can read anytime you like.
Okay.
So, with that out of the way.
What we wanted to end up doing is sharing that with you. When we take a look at what's been going on in the market, okay, what we normally end up doing, okay, in these weeklies is that we kind of end up saying what's happened in the market, what's been driving things. And there have been, as you remember, last Monday we talked about, I said that there was nothing really to drive the market very hard one way or another. I said unless geopolitical activity picked up, and it did, right? Another round of sanctions in Russia, the vote, okay, in Scotland about do they secede from the United Kingdom got to be much, much closer. For those of you that haven't been following that, some of the major banks talked about if they do end up voting, they will move their headquarters and their operations from Edinburgh and other places in Scotland down into England, mostly around London. The thing that's scary about the vote is that I've seen some polls call it close, some polls say it's no contest, but they're letting 16-year-olds and older vote. Now, you ask a 16-year-old, does he want more freedom? Okay, it can be dangerous. It can be dangerous to the UK. You've seen it happen and have an effect in the currencies. Really isn't been priced too much into the market. We have seen some of the volatility products pick up. The VIX futures, some of the VIX ETFs have picked up compared to where the markets have been. But it is a bit scary, I think. If you take a look at the resources, right, we go through our calendars in the U.S., and if I go to last week, most of the numbers last week have continued to show relative strength. We've seen, report after report, things look to be better, and what we're almost in a good news is bad type of environment, because if the news is too good, the Fed, everybody's watching everything the Fed ends up saying, and we have a Fed meeting this week. Everything the Fed says, like a hawk, in terms of what ends up happening. Will they end up changing their language? What's going to happen at 2 o'clock on Wednesday? That's the other big thing we have this week. Will they end up changing their language and stating that for the extended period of time, and will interest rates be affected? We have seen the 30-year. If I take you over to the chart of the 30-year, right, this is what I end up using all the time to take a look at it. We've seen this happen, right? Bond prices come down, yields go up, okay? Pretty consistent march. There's some fear in the market right now because of that. When I take a look at how this has affected the markets, okay? And by the way, what you're looking at, I end up using this. This is the IRA accounts that I end up trading rather aggressively. You can end up seeing, if I take a look at from the July, right, late July, early August, okay, where the market came in, right, pulled back, and we came up, we've been moving sideways. But you can take a look at all of the oscillators, the MACDs, the stochastics, the RSIs, okay, the Williams percent Rs and the CCIs have all dropped. They've all dropped. Some of the things that, if you guys don't use these oscillators, I'll just make a comment. Williams percent R, okay, and then CCI tend to be the ones that drop the fastest. MACDs tend to end up being the last one that ends up confirming. The stochastics that I end up using here, which are the full stochastics, tend to be somewhere in between. On the RSIs, I like to use an RSI with an EMA, just not a simple moving average. All of those are set up in charts in Thinkorswim. And Tom, I don't know if it's possible, but if it's possible for me to end up saving that configuration for anybody, I'd be more than happy to put it up if anybody ends up wanting it.
Yeah, I'm not an expert on Thinkorswim, so that might be possible, but if somebody does know the answer to that, we'd be happy to export it if we can.
If we can, I'd be more than happy to share it with you. What I didn't end up showing you, because I realized that when I was talking about it, on our calendar and our disclaimer, okay, here's the calendar. The big thing is the Fed FOMC meeting that we're concerned that can end up having a big move in the market. We have the geopolitical stuff that's going on, and then we have the interest rates because of the Fed meeting have been moving, and then the last thing is the Alibaba. Okay, ends up having our Friday IPO. So after Friday, between the Scottish vote, okay, the Alibaba IPO, we're going to have a lot of the things that have driven market uncertainty and kept implied volatilities, relatively high and have had this little bit of move. A lot of them will end up being behind us. Now, if interest rates go up, geopolitical tensions increase, Scotland doesn't turn out well, interest rates look like they're going to end up rising. I mean, any combination of those four things can start to make the market pretty ugly because we don't have a lot of those things priced in for bad news. I mean, we've started to see, some tension in the market. Here's the other thing that Ian and I have talked about, and this is something that was a Spear Leagues and Goldman type of thing when we've talked about it. We're starting to see much bigger swings on a daily basis. Let me get rid of all my studies so you guys can see this. Okay. When we've had our movements, yeah, we had our big drops, but one of the things that's been happening is that our bodies of our candles have started to get a little bit bigger and not just uniform. Like, I don't consider this a big candle or these big candles because they're just marches, right? They're marches in just one direction, okay? What tends to end up having turns in a market are you start to end up getting tighter bodies and then they get bigger. We've had tighter bodies and then they've started to get bigger in terms of our candles. Now, here's the thing. I don't know what that means. Do we go up or down? I just know we're not staying here, okay? So I do think for all of you iron condor sellers, and if the skews are too steep, meaning that you're not getting paid enough for them, this is a time you need to be a little bit careful with them because we have the potential that if we get the all signs clear at this point, can we end up marching up to 21 by the end of the year? Oh, easily. What happens if all of these, the four things that we talked about and others, start to end up being rather, nasty? Can we end up giving back our gains for the year? You take a look at the support. I mean, it's very possible that we end up going back down to 1900. Okay, I just feel that we're also in a time of a year, by the way, from mid-September to the end of October that can end up being rather volatile in the market. And while the VIX has started to pick up a little bit, and here's the VIX. While the VIX has started to end up picking up a little bit again, this was the fear that we ran in starting in late July, early August. We've definitely picked up over the last couple of weeks. If I take this and I make this a longer chart, you can end up seeing here, it's not, I wouldn't think anything of it at all if we got up to the, 17 area. I mean, we get up there pretty routinely as soon as there's any type of fear, and that can also end up hurting, okay, any of the options that you might be selling. I know that, I talked to some people who ended up trading after they watched Len Yates on Thursday, okay, last week. We talked a little bit about his VXX system. And you can see that, we've started to get a turn up in the VXX. Please, and this is one of the things that I had a conversation with, you cannot use technical analysis on the VXX. It's just not possible. What it doesn't end up showing you, it doesn't end up showing you the natural drag that these products have on them because they can't end up actually buying the VIX. They have to use the VIX futures. And because of the way the VIX futures end up working, there's a natural drag in them. Some people end up, and I've been told that a lot of people like this website, okay, VIXCentral.com, it ends up showing you the difference between the front month and the second month. Each of the months are listed up here in terms of what the futures on the VIX are trading. And you can see the Septembers and the Octobers and Novembers. And this is a very typical trade. I would say that we're in this environment probably easily, 90% of the time. And when you get out of it, you get out of it for, panic type reasons. In 2008, we, especially second half of the year, we were in backwardation, meaning that the front part of this curve, the September and the October, they were much higher than the back ends of the curve. When you take a look at the percentage difference between the first 2 months, you can see that we're at 5%. We've been between like 5 and I'd say 5 and 7, 5 and 8% for months on end. So even though the implied volatility has moved up a little bit, okay, this natural drag has not. The 5 to 7%, by the way, means that because there is no way for somebody to actually go out and buy the VIX. The VIX is a very interesting product because the VIX is the only future that you can't hedge with the cash underlying or the spot price. You can buy spot gold. You can end up buying gold futures. You can buy the S&P 500, the SPY, or IVV, or pick your favorite ETF, and you can hedge it against the VIX, against the SP E minis or the ES futures. You can't do that with the VIX. So the very nice people at Credit Suisse and ProShares put together, basically billion-dollar ETFs for you guys to buy, meaning the retailers, so that you could end up buying the VXX or the VIX, or pick your favorite ETF or ETN that does this. The challenge with their implementation, and it's not, it's the only way to implement it. So I'm not saying that they did anything, poorly in their design, but the only way to do this is to buy, have a combination of September and October futures. The problem with this is that for argument's sake, if we took a look at the September futures and the October futures, if the September futures were, say, 15 days, and the October futures were 45 days, and I know that's not possible because it needs to be either 28 or 35, so don't send me emails on it, but just to make, the math work on this, okay, if they're half of them are 15 days, half of them are 45 days, the average is 30. What happens tomorrow? Well, tomorrow they've each matured a day, so now there's only 14 days left to expiration on the front month futures and 29 on the back month. So they have to sell some of the front month futures and buy the back month futures. So over the course of the month, they have to end up rolling 100% of their portfolio. So over the course of the month, if nothing happens, if everything stayed identically every single day, VIX did move, the VIX futures did move, this would end up losing 5.06% of its value in a month. That's an enormous drag to end up overcoming. Now, it changes every single day. And remember, when fear happens, the front month ends up moving. That's why, you know, the VIX, the VXX, these aren't great products to end up holding long term. When they do move dramatically. You can see here, you know, if you had bought in late September at 28, you only held, you know, a week and you were 35, right? So when they move up, they can move up like, you know, a scolded cat. But otherwise, they can also end up, okay, moving sideways, or you can end up seeing the, you know, long-term drag down that these things end up having. What we end up doing is, I know some of you guys talked to me about Len Yates's system. We had built, and I'll end up sharing the graphs. I can't end up sharing the code because it was something that with Ian's company we ended up building. If I take a look at just the time frame, let me get a little bit longer time frame here for you to be able to end up seeing this. We ended up building a volatility indicator. You know, we had looked at Len Yates's indicator, and we looked at Steve Lentz. Okay, he had done a lot of the work, and I know it's the Lentz indicator, and we looked at it. We looked at you know, moving averages. We looked at size of daily bars, or ATRs, if you will, have a fast indicator and a slow indicator. And what we ended up finding is that you get a lot of little bumps in this. Let me just get rid of these things so that you can end up seeing it. If I come over here, I'll delete that study, and let me delete this study so you can okay, there, now you can end up seeing, right, so it has a little bit more range in it. So over here you're looking at the VIX. Over here I have a graph of the VXX versus the UVXY, the single negative versus the double negative. So you can see how the double leveraged inverse, okay, and I'm sorry, they're not inverse, they're just long VIX, ends up having a lot more drag over a period of time. And over here, what I end up doing is that I look at, some people like the looking at the website that I showed before, this one, VIX Central, they're delayed, right? So what I actually look at, and I look at a map of each of the fronts, each of the front month, first month versus second month options, so I can see how that basically trends. The thing that you'll end up noticing is that if I end up going back to, say, an ugly period of time, like let's say with the budget issues that we ended up having in 2011, you can end up seeing that we had plenty of notice to end up getting long the VXX. Right, because we got long, okay, right at this point, right, when our slow indicator and our fast indicators were both above it. So we're nowhere close to this. So the bottom line is that on this stuff, with everything that's going on, implied volatility is moving higher. It can get up quite a bit more before we end up getting into any type of a panic issue. The technicals on the SPX or on the overall market are reasonable. They've definitely sold off. We're not in any type of panic type of, let me just get in, right? If I show you SPX, what I will end up telling you is that the large caps don't look nearly as good as the small caps. When you take a look at the Russell, okay, the Russell has started to end up having some larger okay, daily bars, and just had a horrible, horrible day today. There was quite a bit of a sell-off in it compared to the overall market. Um, do I have it here? The Russell was down 121 basis points today compared to the S&P, which was down marginally. You can see it over here, too, right? Down 121 basis points, down versus 7 basis points. So we're definitely getting some rotation. The Russell has been stronger for quite a bit of time. Last year it was much stronger than the overall market, and we're starting to get it's starting to roll over first. So there's more and more, I think, challenges. You can end up seeing on this chart on the Russell, the red line that you see right here is the 200 period exponential moving average. It's been tested twice over the last couple of years. Both times it held and we moved higher. It looks like we're starting to challenge it again. And this time, we'll see. It'll either be a really good buying opportunity, or if we do break through it and it becomes resistance, it could end up getting ugly. So I guess buyer beware is the bottom line here.
I have a few extra long puts.
A few extra long puts. They never end up hurting. I can show you if you want this right in the IRA. Okay, that's the trade that I currently have on. Okay, broken wing to the downside. Right, so it gives me a little bit of room. It expires on Friday. I might have to roll it. Here was an interesting trade that I put on a while ago. And this was when we first hit 2,000. I said, there's at least a reasonable chance that come the end of the year, we're still battling over 2,000. I remember, Tony, I don't know, you're an old enough trader like me almost. I don't know if you remember when we first hit Dow 10,000. We battled over 10,000 for, years. Years we battled over it. We've run so far to get up to S&P 2,000 that I just thought, there's a good chance that we end up, just battling over this thing for, forever. So I ended up taking a look. I sold in December. In the big account, I sold January's, right? In my fund account, I sold January's because I can't trade same months in the IRA that I trade in the big fund. But I like this trade. I ended up getting it on for, if I end up taking a look here. Let me import. Let's see if I have it right here. This is an old one, so I got to take out a bunch of stuff. So what I basically, no, I don't have it in there. I thought I had it in there. Sorry, let's just go back to this. Anyway, so that was a trade where I thought, not a bad trade to end up risking a few dollars to make, if it ends up landing. It's almost like buying a lottery ticket. Again, it's buying a lottery ticket with a little bit of logic behind it where, I think that I'm risking less money than I am to be able to collect what I could possibly collect, and I have very limited risk.
Yeah, I did the same trade 10 times instead of 15. It's already up, and yeah, it's a nice trade.
Yeah, it's a nice trade. It's up $400. Okay, I've only risked $3,000. If the trade ends up being, Ian and I joke. He says if it's a Russian gymnast and they can stick the landing right on the top of this thing, okay, it's nice. Now of course, I would never hold the whole thing up to there, but if I can end up getting off my initial investment, I can end up letting some of it run. I'll end up doing that.
Sure.
Anyway, any other questions we end up having?
Let's see. Okay, so I guess there is a way to save a chart. Somebody said you'll have to hit the share icon and post the link given by TOS. Anyone that uses TOS will be able to load the chart using the link.
Will they end up seeing my code?
I don't know about that.
Okay, that I have to end up checking out. I'll call up TOS, and if I can end up sharing it without sharing my code, I will definitely do so. If you guys like this chart, okay, what I chart here, and this one I have to end up updating all the time. What you're looking green, yellow, red, you're looking at the second month versus the first month VIX futures. That is the VXX. That's the VXX contango. Okay, and you can see what happens. I chart it out on a 5-minute chart, and I leave it up for a week. The yellow is the third month minus the second month, so it's what the VXX is going to be next month. And then the red is the fourth month minus the third month, so it's what it's going to be in 2 months from now. And the purple line is the first month minus the cash. That one has so much noise in it that I don't want to end up seeing. And then I end up drawing just 1 standard deviation and 2 standard deviation channels around the VIX. I do it for a 6-month period, and you can end up seeing that, I'm not all the way over to the left. You can see that we're definitely channeling upward. So this is a nice one, especially if you guys are VXX or VIXY or UVXY or XIV type traders. You know, this is one that I keep up all the time. There's no code on here, so I'd be more than happy to share this one. The other one, I just have to make sure that the ThinkScript.
Yeah, Adrian said yes, the code, no, not the account balances, and Dave Stewart said this is the chart. The one you're looking at now is the one he likes.
Okay. Yeah, what I'll end up doing is if you just email me how to end up sharing it, I'd be more than happy to do it, and I will update it on a monthly basis because every month I have to go and change all of those VIX future codes. Okay, you know, which one, you know, was the X, was that October or November, and where was the U? I thought it was, you know, those things. So I have a little cheat sheet, and I updated, I'll update it on Wednesday morning again.
Sounds great.
That's when we will.
Any last words of wisdom, Tony?
Oh, hey, I had my microphone muted. No, I think, yeah, you know, the whole you know, the VIX and the VIXY and the VXX and all that stuff, you know, it's a little bit, you know, much to get your head around until you practice it for a while. But I would ask you the thing that when I was listening to you, I'm not sure if I wanted to say, you know, get long Vega in that type of trade right now. What would be the simple way, Jim? What would you just like, supposing you had no position at all? What would be the things that you would entertain in terms of, you know, the months and the strikes and the actual instruments is how you would, you know, proceed with that. And this goes along with the, you know, your version of the Lynn Yates, you know, volatility trade.
Right, concept of when to end up getting scared, right? Because what you're looking at here is the VXX from the time it started the trade. Okay, back in 2009.
Yeah.
Don't forget that it came out in March of 2009. The market's crashing. I mean, this product was built to end up selling, right? So telling people they could end up buying the VIX or a VIX substitute in March of 2009, I mean, it was like selling candy to a baby. The challenge with it is that, you know, you can't end up holding this for any period of time. Because if you take a look at it, it basically went from 7,680 down to 30. And you say, well, it lost all of its value here. But look, if I just end up highlighting this piece, you have the same graph. I mean, so from a percentage-wise, say, well, it hasn't gone down too much over the last 2 years, a year and a half, has it? Yeah, it has. So you can't end up owning it. So to play the volatility on the long side, how do you end up doing it so that you don't have this huge draft against you all of the time? The trade that I end up liking, if we come and we take a look at the implied volatilities of the VXX, okay, by buying something even just, let's take maybe, a few weeks out, I can end up buying something above the money and then selling something well above the money. And over here, if you take a look at something like this, if we ended up buying the 30 call for, let's use the ask on each of them. We buy the call for $1.75. You see that price there, Tony?
Yeah.
And the vol is 65.5. And we ended up selling the 34. We're buying a 4-point wide spread, and we're getting 96 cents. So for, let's call it, 89 cents, I'm buying a $4 wide spread, and I'm buying a much lower vol and selling a higher vol. So to me, that's something that I can end up living with if I wanted to end up making that bet. So let me just take you over to here. Let's show the whole thing, and let's get rid of what we ended up having over here. Right? And we ended up doing what we talked about, maybe just even in October, 32 days out. If I buy a vertical, let me just take here, right? I'm looking at my implied volatilities here. So I want to sell something, right? I'm buying a 62, and if I did it to 35, I'm selling a 78. I have an 18-point advantage in the vols.
Right. Mm-hmm.
Right? So now what happens is, and when I take it a risk reward, I'm basically risking 96 cents, and it could make as much as $5. So every contract that I put on, I have $96 of risk. I can make 404. Okay. So if you're going to end up playing that, using the options is a very, very controlled way of being able to end up saying, hey, I kind of like that as a possibility that things could end up moving, and I control my risk. One of the challenges, okay, that I've seen with most people who try to trade, okay, the UVXY, people who, when do people talk about buying the UVXY? When it looks like we're on the verge of world peace? Or did they end up doing it, okay, in early August after their portfolio took a hit? Right?
Yeah,
I
right.
can guarantee you, people who end up trying to buy this, okay, if their average price, okay, when they got scared, if it was lower than 32, I would be shocked. Okay, most people are going to buy it when they think they end up needing it. They're not going to buy it now. They're going to buy it once it starts to go up. And if you want to, I'm not saying don't play it that way. I'm just saying, you take a look. If you ended up buying this at 34 and a week and a half later, you're at 27.5, you're a hurting puppy, okay, because your portfolio didn't bounce that much. So
Jim, you're saying that you could basically use this as sort of a base trade to go along in time as a hedge. I mean, in a way, of course. I mean, I know it's a separate instrument, but given the drag, that you've talked about, it seems to me that it's a good, long-term sort of time-traveling rolling trade to have as a base almost.
It's not terrible. You know what? Because of the way things end up moving, some people would almost prefer to end up, because of its natural. It depends on what you were trying to protect, Tony. Let me start by saying that. Like, for example, if you're not worried about a little pullback, you're worried about a 2008 and, something, cataclysmic happening, you could end up putting on a trade that would end up looking a little bit different in the sense of, if I ended up doing something like this, and let me say if I just did a 2x3, and I got this so that it was far enough.
So you did yeah, okay, got it. Oh.
Let me go here. go to 32.
In other words, basically you're saying you could determine how long you want to be on that.
It also depends
Right.
on what area you're trying to end up protecting. Like, for
Yeah,
example,
good point.
if I'm trying to protect against a market crash, not a little pullback I don't care about. I'm trying to protect a market crash. Doing something like this, okay, which cost me 49 cents. I'm selling 229s and I'm buying 331s because if this thing bounces up, I'm not worried about it moving up a little bit. I'm worried about if I go back to the charts. Hang on here. If I go back to the charts, I'm worried about something like this, right?
Mm-hmm.
I'm worried about it going from 1,100 to 2,300. That's what I'm worried about, right? We call that tail risk, by the way. What happened during the time when the S&P was running then? Okay. Right, the S&P went from 1,300 to 1,120. Right, it went from 1,350 to 1,120. Right, I'm worried about this type of drop. We call that tail risk. If I end up taking a look at what that ended up meaning and how to best protect a trade like that, it's something like this because this would end up going up to 60. And over here, I would be risking, losing $49 if it went down. Granted, I have a portfolio. I have a Reg D margin of 400. I'd never hold the trade, by the way, during the last week. You'll see. I'll show you what happens in this minute. But here, I have a very small amount of money to be able to end up having tail protection. And the reason why this is very good tail protection is, oh my God, what happens if you hold this? Because this has such high implied volatility, look at what ends up happening with this. Even if I get out 8 days before, I didn't lose the 400. Even at the worst possible spot, I'm down maybe 140. I get out 2 weeks beforehand on this and I roll it out to the next week. It cost me $76. What are you trying to protect? One of the things, I do this a lot. You tell me what range you're scared of or what you want to protect or what you want to make a profit for over what period of time, and I'm going to look at the vol skews, take a look at the overall term structure, right? The vol skews, by the way, just so that I know some people don't speak, code, but we take a look at the vol skews or the difference between, let's say, the calls and the puts. Right. This has a call skew, meaning that the calls have a much higher implied volatility on the VXX than do the puts. But if we take a look at something like the SPX, it's going to be completely the opposite. The puts are going to be a lot more expensive than the calls. It takes a second to pull in data because there are just thousands of contracts here. But you can see how the puts are very, very much more. So everything for me starts with looking at the vol skew curves and then choosing some way to, and now this is the tough part, right? Selling, high volatility and buying low volatility parts of the curve, right? And the term structure ends up meaning what is it if we go out in time, right? If I just get rid of a few of these things so that it's easier to see, not as much. What happens if we go out in time and look at different strikes? And I'll be able to, it's a tough curve because it's SPX. There are thousands of these things. But I'll be able to end up seeing what they look like in a three-dimensional model and knowing what is junk. Like, for example, some people say, oh, my God, I should definitely sell these, right? Look at how high these are. Well, here's the problem with selling these things. You get 15 cents for selling a contract on a $1,700 put, $1,750 put. This is the definitions of picking up pennies in front of a steamroller. You're going to win most of them, but every once in a while, the steamroller is going to roll over you. So how do you end up doing that? In some ways, that's almost worth it to buy as tail-type protection, but if you buy it on a constant basis, you'll lose money, and then when you finally do win it, you'll probably only make back a fraction of what you lost over the years. And the reason why you can't sell it naked is that you can't sell it naked because when will you lose? You know, statistically, you might lose 1 out of 10,000 months or 1 out of 100,000 months. But what happens if that next month that you're losing month is next month or 6 months from now? Tony, that will change your life, okay? Because the loss will be substantial.
Oh, yeah.
Right?
Tony actually had to go leave to pick up his son from school, so he actually isn't here. But yeah, that was a good question. And then yeah, I like the idea of picking pennies up in front of a freight train or a steamroller.
Right.
You will get flattened.
Yeah.
Dave
We'll
Stewart,
try
last question. Oh, he said, have you looked at the concept of sticky strike versus sticky delta when you're looking at vol skews?
I know sticky strike. I don't know the concept of sticky delta.
Okay.
I'm sorry. Dave, if you type that in, I'd be more than happy. I just don't, I may know it by a different name. Okay. Sticky strikes are easy in terms of, it's easy to take a look at where there are battlegrounds. So, you know, if we chose, let's choose everybody's favorite Apple. If I go and I take a look at areas, I'll take a look and see where there'll be a lot of traffic, okay, where there might end up moving in different areas. Right now, you know, it looks like we're having a battleground somewhere between, you know, 98 and change and 103. You know, so we'll take a look. 100 would be a nice area to play. You know, Apple will probably battle over 100. I love the fact that they're round numbers. The bigger the round number, the more there's a battle that goes around. So sticky strikes tend to trading there. What Dave ended up saying, for those that don't see it, is a sticky delta is say that the strike will end up changing, but the deltas will end up remaining the same. Okay, yeah, in the vol. I don't look at changing the trade on a regular basis. What I do is that I do look at my deltas. I do look at how they change. I do take a look at, because the concept is when the price ends up moving, the problem is that any model that you look at is always going to end up having, you know, in my mind, you know, some type of an issue. If I took a look at, and we just talked about maybe doing a $100 butterfly, if I do a deep and wide $100 butterfly on here, just, oh, we don't want to make 20-point wide wings, right? Where are we? We're in October. I don't know. Let's make, let's be real aggressive and make them 10-point wings. Even that is a bit, I think, robust. But what will end up happening is that my deltas will end up moving. Now, one of the things that I used to end up doing, and this is not a criticism of Thinkorswim. This is pretty much of everything. I use LiveVol a lot. The graphs I was showing you were LiveVol before. One of the things that will end up happening is if I want to end up keeping my deltas constant, as we run up, if you're not doing this in an IRA, I will take a look at selling some of my in-the-money calls, okay, or in-the-money puts if I'm trading put butterflies, to end up managing my deltas. I love the concept of selling deep in the money stuff, okay, to end up balancing things because I feel I'm taking risk off the table, which is a nice way to do things. Where we are right now, if we end up moving up, you know, selling some out of the money calls, if we run up in this case, is a nice thing because they're the ones that are all extrinsic value. And it's a way to keep my deltas managed. So by sticky deltas, will I keep things in ranges? A lot of times, yes. I will try to end up doing that. And I call that my peel process, because what I try to end up doing there is that I try to sell off some or close some of the pieces of the trades. And I love to sell my longs because when I'm selling longs in the trade and I'm managing my deltas that way, I know that my theta is going to end up increasing. I won't do it that I'll take, you know, unnecessary risk. if I ever sell longs, it's going to end up being that we have to make money before we lose our maximum amounts, okay, in any type of environment. So that's the way I'll end up trading those. But yeah.
Well, great. Well, Jim, I think we're getting a little long here, so probably time to wrap it up. What do you think?
I was done. I was just answering questions. Tom, thank you very much. Sorry that it took us longer, but I thought that starting off with Ian would be an interesting way to end up going, because I know a lot of people were looking at how to end up playing these things, and I just wanted everybody to think about when you have an event, to end up giving it thought and try to play it time appropriate, meaning early enough, and you want to be in the trade before everybody else is.
Yeah, that was a great discussion with Ian. Thanks for bringing him on.
No problem. Yeah, Ian, I've asked him. Ian's willing to come on once in a while and end up explaining trades and stuff. So if he does a lot of event trades in and around earnings. So at some point on a Thursday, maybe we'll get him on and he'll kind of go through a process of what he ends up doing. That'd
be great. All right, so that'll do it for now. And Thursday will be Greg Harmon, author, be talking. I think about his recent book, the same subject, so it'll be an interesting roundtable on Thursday. And then Tony Sizemore is actually going to join us the following week, but on Wednesday, because he has a conflicting event on Thursdays. So we've got the next 2 weeks planned out.
Thank you, Tom.
All right, thanks again, and we'll see you Thursday.
Bye now.
All right, bye.